you ever had a price reversal and hit your stop right after you entered a trade? Often the problem is not the entry point. The problem is that the market is looking to collect liquidity before the main move. In this video, we see what a liquidity sweep is and how to check with EMA 21, whether this move could be a scalping opportunity or not. Have you ever had a price reversal and hit your stop right after you entered a trade? Often the problem is not the entry point. The problem is that the market is looking to collect liquidity before the main move. Liquidity in the market refers to areas where there are a large number of orders and stop losses. Usually, a large amount of liquidity accumulates behind important ceilings and floors. I understand liquidity as follows. When the most orders are collected in an area, and the price always finds a way to remember it, and after it finishes its work, it makes a fake move and collects the stops that are in the opposite direction of the opening and goes to its main trend. But the important point is this: not every ceiling or floor break is a real break. Sometimes the price just makes a quick move to collect liquidity and then starts its main path. We call this move liquidity sweep. Now, to find better opportunities, we add EMA 21 to the chart. Our goal is to check whether the price reacts appropriately to EMA 21 after a liquidity sweep. In the backtest, we look for situations where the sweep has occurred, the price has reacted to EMA 21, and the entry conditions have been confirmed according to the rules of our strategy. Remember, liquidity sweep alone is not a definitive signal. Risk management and other confirmations are always important. Well, now let's go backtest this strategy and see what the combination of liquidity sweep with EMA 21 gives in practice. Don't forget to support, like, and subscribe, because now I'm going to hunt for a position with the liquidity backtest. Here we have the first position. First, look at this ceiling. The price has already reacted to this area, so there could be liquidity above this ceiling. Now the price comes above the ceiling and sweeps the liquidity, but instead of continuing the move, it quickly goes back down again. We are not entering the trade here yet. We are waiting for the price to return below EMA 21 and the confirmation candle to close. Now our entry is here. We take a sell position, place the stop above the sweep range, and set the target at the next liquidity on the lower side of the market. And here you see that the price moves towards the target after confirming EMA 21. So the important rule of this setup is first sweep, then confirm EMA 21, then enter. Now let's move on to another example. Second, here we should first look at the previous market low. This is the area where there are probably a lot of stops and orders waiting. That is, a liquidity range. The price moves towards this low and penetrates below it for a moment. Many traders think that the downtrend continues here, but in fact the market is just gathering liquidity. After the sweep, the price returns above the range. Now we check the EMA 21. When the price consolidates above the EMA 21 and upward momentum is formed, this can be a confirmation to consider a buy entry. The entry is made after confirmation, the stop loss is placed below the sweep range, and the target is set at the next resistance or liquidity. The important thing is, we are not just looking for breakouts. We are looking for breakouts that show the true direction of the market after gaining liquidity. Third, now let's look at another example. Because not every liquidity sweep in the market always creates a good position. Here the price makes a sweep, but we don't trust this move alone. First, we need to see what the market structure shows. If the price, after gaining liquidity, returns without enough strength and cannot find a suitable position relative to the EMA 21, it is better not to enter the trade. But in this example, after the sweep, the price shows a clear reaction, and the EMA 21 also confirms the direction of the move. This is where a professional trader makes a difference. He does not chase every quick move in the market, but waits for a combination of several valid signals. So always check these three steps: liquidity area, liquidity sweep, confirmation with EMA 21. The more filters you have, the fewer trades you will make, but the quality of the setups can be better. Now let's move on to another backtest. Here we have an important area on the chart. The price has reacted to this area several times, so there are probably a lot of orders around this area. We wait to see how the market reacts to this area. The price first moves down and breaks the previous low. At first glance, many may think that the downtrend continues, but we are waiting for confirmation. After this breakdown, the price quickly returns and is above the previous area. This is the liquidity sweep. Now we check the EMA 21. When the price shows strength above the EMA 21 again and a confirmation candle is formed, the conditions for considering a buy entry become better. We make the entry after confirmation, place the stop loss behind the sweep area, and set the target at the next resistance area. The important thing is that we do not guess where the market is going. We wait for the market to first collect liquidity and then enter with confirmation. Now let's look at a sell example. Here on the chart, the price has reacted to a certain ceiling several times, and above the ceiling, there are probably many buy stops. The price returns to this range again and moves slightly above the previous ceiling. Many traders think that a breakdown has occurred here and enter the buy. But we wait. After taking liquidity, the price cannot consolidate above this range and returns below the previous ceiling again. This move could be a liquidity sweep. Now it's time to check the EMA 21. When the price breaks below the EMA 21 and there are signs of weakness in the movement, this can be a confirmation to consider a sell position. Entry is made after confirmation, the stop loss is placed above the sweep range, and our target is the next liquidity area below the market. The important thing is that we do not trust the initial breakout. We wait to see if the market really wants to continue or if it is just coming to collect liquidity. One of the biggest mistakes traders make is that they think that every time the price breaks a higher low, a trading opportunity has arisen. But in reality, not every breakout is a liquidity sweep. Sometimes the price just makes a normal move and then continues its course. That is why we need to learn the difference between a real breakout and a liquidity sweep. The second mistake is that traders look at only one candle and make a quick decision. While we should be looking at the area, the market structure, and the price reaction after the sweep. The third mistake is using the EMA 21 incorrectly. The EMA is not supposed to give a buy or sell signal on its own. It is just a filter to detect the strength of the market movement and its likely direction. A professional trader is not looking for a large number of trades. He is looking for situations that have several reasons to enter. Liquidity sweep plus EMA 21 becomes more powerful when both are used in conjunction with the right market structure. So in this video, we saw how we can combine the liquidity sweep with the EMA 21. First, we wait for the price to gather a significant area of liquidity. Then with the help of EMA 21, we check whether the market movement has the necessary confirmation for entry or not. If you want to learn more strategies like this with real backtesting, subscribe and don't miss the next videos.